Welcome everyone to our Ask the Experts webinar today. We will begin the webcast in approximately 1 minute. Welcome everyone to our Ask the Experts webinar today. We appreciate each of you joining. We have some compelling topics to discuss today. My name is Drew Niehaus, a Managing Director at Riveron. I'm joined by three of my colleagues, Keith Brown, Todd Follett, and Sasha Morzova, all Managing Directors with the firm. Today on the agenda, we are going to discuss a range of topics related to the impact of the novel coronavirus or COVID-19 on financial reporting and accounting. Before we get into the content today, a few key reminders. On our website, riveron.com, you can access our previous Ask the Experts webinars, including navigating change in a distressed environment. And perhaps most importantly, we will be hosting our next Ask the Experts webinar in the coming weeks on the status of supply chain and the impact of the pandemic on the aerospace and defense industry. During the webinar today, we will include 4 polling questions, which must be answered in order to qualify for CPE. Also, we welcome your questions. There is a Q&A option in Zoom that you can use. Please feel free to do that. We will try to get to your questions, but if we don't, we will respond separately. The webinar evaluation form and CPE certificate will be emailed to you within 2 weeks, along with access to the deck presented today and our contact information. Please note that while the on-demand video of the webinar will be available on our website, the on-demand is not eligible for CPE. And one last administrative note, as we are all presenting and listening remotely. If you do have an issue with the audio feed, we'd encourage you to be patient, and if it persists, joining via computer audio is usually preferable. So with that, let's get started with a discussion of some of the incremental strategic functions the accounting and finance teams are being tasked with in light of the global crisis we are facing. Keith?
Thanks, Drew, and thank you everyone for taking the time to join us today during this unusual crisis. Many of us have lived through major disruptions such as changes in economic conditions, natural disasters, 9/11, and the Great Recession. But this pandemic we are facing today with COVID-19 and its effects are much different than any other scenario that we've encountered. It's nearly affecting the entire world, with direct cases in at least 150 different countries. And with the shutdowns and ripple effects, the disruptions to supply and demand are monumental. As a result, people and companies are forced to practice social distancing and remote working environments in many cases. Our day-to-day lives and finance and accounting functions have dramatically changed in many ways, at least temporarily. Today, we're going to discuss best practices in adapting to these changing circumstances in a remote environment. We're also going to cover technical accounting implications to consider. But first, I want to spend some time sharing what companies have been doing from a business perspective in the immediate term over the past 2 weeks and expect to continue over the foreseeable future, and how your finance and accounting teams are playing key roles in supporting the business and planning for financial resiliency. After hearing from clients and companies of different sizes and industries, We broke these immediate activities into three major buckets. First, liquidity management. Second, operational continuity and cost control. And third, out of the norm reporting and other regulatory activities. So let's start with liquidity management. There's obviously a heavy focus on cash flow modeling, optimization of working capital, and maximizing available credit. Finance teams are running 3-month cash flow models, assuming worst case scenarios, and stress testing with, in some cases, assumptions of little or no revenue and significant slowdown in customer payments or zero collections. Companies are depending on their finance team to provide accurate information around assessment of collection risks by customer and quantify likely revenue declines over time. On the payables side, it's a focus on extending payment terms, reviewing purchase agreements for savings opportunities, and identifying discretionary spending areas to put on hold or cut off. However, it is also important to protect those relationships with key vendors by early negotiations of long-term contracts and identifying backup options to be prepared for a quick transition to the recovery mode. For example, Grubhub, whose lifeline is the restaurant industry, is deferring collection of millions of dollars of commissions for impacted independent restaurants until this pandemic passes. This is a good example of a company with the ability, at least for the time being, to help other companies minimize the bleeding in an effort to strengthen goodwill long term. From a treasury perspective, companies are looking to max out their current revolvers right now and upsize existing credit facilities as soon as possible. Some are negotiating standstill agreements with lenders and temporarily halting interest payments. Accounting is factoring these options into the management's models. Another one, it is important to understand your hedging positions. Companies that had previously entered into derivatives such as fair value and cash flow hedges that are currently in the money are considering terminating those derivatives as a quick liquidity option to receive cash from their banks. There are a fair amount of those settlements happening over the last week. Finance teams are also reviewing business interruption insurance policies to understand the coverage and how to factor this upside into the cash flow models. Turning to operational continuity and cost control for a couple minutes, companies are building driver-based financial forecasts, including very conservative, moderate, aggressive scenario planning. Some of the considerations include suspended or reduced business operations, as well as identifying financial and liquidity levers to pull at different points in time. Being able to reflect and articulate the accounting impacts of those potential actions on a real-time basis are important in the company's strategic decision-making. From a revenue standpoint, finance teams will need to analyze significant customer contracts to determine if their exposure, if cancellations or deferrals occur. And then on the cost control effort, management is depending on the finance team to assess these potential financial levers to distinguish between cash expenses versus GAAP non-cash expenses as scenarios are being evaluated. Accounting is assisting with estimations around supply chain exposure within supplier tiers, as well as inventory levels, given the reliance of many companies on low-cost suppliers from East Asia. Sales and operations planning teams are partnering with the finance teams to set up a pandemic relief expense budget with clear policies and controls, and to help key stakeholders make quick decisions about short-term rises in material costs, inventory buildup, and inbound and outbound logistics. From a workforce perspective, companies are proactively looking for good alternatives to employee layoffs, such as reduced work schedules, furloughs for 60 to 90 days with limited pay and or benefits, mandatory vacations, and even decreased 401k contributions in some cases. Various combinations of these types of scenarios are being factored into forecasting. Capital projects that are not in final stages or not expected to be completed in the first quarter of 2020 are being evaluated for delay or cancellation. Finance groups are helping to prioritize investment spending and freezing initiatives such as building renovation projects. They are also considering where to rationalize software licenses and reduce technology capital purchases. Companies are prioritizing payroll costs and delaying rent and mortgage payments while trying to negotiate alternative payment terms with landlords and lenders. The accounting team is assisting with reviewing advertising contracts to assess ability to recoup or avoid marketing expenses, including event spending. And then this third column here is a catch-all bucket. We have out-of-norm reporting and monitoring other regulatory activities. So finance teams are spending a lot more time reviewing debt covenants and stress testing cushions to understand the timing and immediate impacts of potential defaults. We are all monitoring the stimulus and bailout efforts and the impact to each industry and business. Yesterday, as most of you know, the Senate just approved a $2 trillion stimulus deal that is expected to be signed and finalized later this week. In addition, we are closely watching the SEC's decisions around extending future financial reporting deadlines and how that affects the change in priorities and day-to-day activities. More to come on that update a little bit later in the session. The tax laws are changing frequently as well, and the companies should consider extended filing deadlines into your cash flow analyses. Another thing to think about, since the COVID-19 pandemic has been declared a national emergency, there are tax strategies to consider, and the accounting group should be focused on tracking costs incurred relating to supporting employees through this time. So for example, many companies have mandatory work from home policies with no determined end date. New benefits provided by companies to accommodate them, such as telepresence technology, childcare credits, meals at home, and special bonuses that normally might be considered personal taxable expenses, now might be tax-free if related directly to the national emergency. So we covered a lot here, and these examples are not meant to be exhaustive, but hopefully they are helpful to think about and be prepared for as the influx of these urgent, non-routine demands come into your accounting group to support this crisis response. And now I'm going to turn it over to Todd to take us through best practices in adapting to this new full-time remote work environment for our finance and accounting teams. Todd?
Thanks, Keith. I'd venture to guess that almost everyone on this call who has responsibilities for closing the books is going to have to make changes to the normal process they typically perform at month end. So even think about global teams who are used to remote meetings, they typically have some sort of face-to-face interaction with team members during the month end close. And over the last week or so, many have moved to a 100% remote environment. The expectation is that many more could move to stay-at-home mandates by the end of the month. So that presents a whole host of challenges that should be understood and considered as you're planning for a successful March close. First, there's going to be a big shift in culture and team dynamics. You're going to be shifting from a process that's built on a high amount of personal interaction and that's likely going to go away as companies take a people and safety first approach. In addition, teams could experience disruptions in team composition. It's not fun to think about, but it could be a real challenge, either because the employee or family member is impacted by the virus, or unfortunately, potentially because headcount is reduced as part of cost savings initiatives. And this means that teams are working remotely and possibly performing tasks they aren't terribly familiar performing. There's going to be a big challenge to stay efficient and effective as you're trying to manage the process through remote meetings. Interesting story here, but I have a client that told me they've adopted the free version of Zoom during the shutdown. And this has forced them to be more efficient in meetings because the free version is limited to 40-minute meetings if more than 3 people are on the call. So when they hit the 38-minute point, they're looking to wrap up pretty quickly. So communication is going to be a huge challenge. I've talked to several clients over the past few days, and that's the recurring theme. They used to get so much done and done quickly, pulling people into their office, popping heads into cubes, or catching up in a hallway. And now everything has to be very, very intentional. For clients still in the middle of audits, that's even more complicated because not only do you have to talk to your direct teams, but you're trying to manage communication with third-party vendors as well. Another challenge is going to be technology dependencies. So depending on the company or even individual groups within a company, this could be a small challenge or it could be a really, really large challenge. I talked to a controller earlier in the week and she's got it both ways. Her GL team's set up to work remotely because in the past they've had to work nights and weekends during peak time. So they have laptops and VPN remote access. But there were other groups in the organization that were critical to the close process. So their AP team, for example, that had never worked outside the office. So there's a massive scramble to get them set up where they could work remotely and work efficiently in this new environment. In addition to hardware and system access, not all those employees were knowledgeable about how to log in and use VPN, screen sharing tools, etc. So it's all trainable. It just takes time, organization, and communication that shouldn't be overlooked. The last big challenge is internal controls. If you work in a company where documentation of internal controls is very paper intensive, you're going to want to spend some time thinking about how you might change your processes. I talked to a public company controller who mentioned that they shifted their journal entry review and balance sheet rec process to the cloud this past year, which included, everything from document routing to archive of support papers and evidence of review, etc. But she said, had they not done this, they'd really be scrambling because they were highly reliant on paper before the conversion. She said, yeah, we could move to scanners, but not everybody has a scanner in their home office. So they would have been stretched to figure out how to document all this. So understanding these challenges, we wanted to share a few ideas of how you might anticipate challenges specific to your team and work to mitigate them before the timing and accuracy of close is at risk. So at the top of this next slide, I wanted to list a few questions for consideration. And the idea isn't to provide you a comprehensive list, but rather just to plant some seeds to the questions you should be asking and then adapt the questions to your specific situation. So for example, what has historically been done in person or physically that will have to be redesigned for a virtual work environment? So things like paper invoices, receivers, time cards, physical signatures, those kind of things in the actual operations of the business, or even things just in the accounting close process. So review of journal entries, balance sheet recs, etc., that are historically done in person. What alternatives are available as workarounds? And I'd encourage you to get creative. Maybe it's taking pictures of invoices and physical signatures. Maybe it's utilizing snipping tools to capture images and attach them to emails, etc. Next, what's the normal accounting functions that are at risk in this remote work environment? So leveraging the examples above, if you think about the challenges we talked about above, think about, how can you confirm the accuracy of your AR, AP, or inventory when you are highly reliant on paper? Or how can you get a good comfort level with your review if you're used to sitting in people's offices and actually talking through work papers? Or I've been in client situations where during the close process, we're in meeting rooms and we're whiteboarding challenging accounting matters. And we're thinking through, how do we get through this issue? So, so that's going to be a challenge as well. The third question is, what tasks will take longer to complete in a virtual work environment? And these are typically things that are iterative in nature. So reviewing of journal entries, balance sheet recs, working through challenging accounting matters, like I mentioned before. Anticipate and plan for what these are going to be. And then finally, what new technology teams or support tools will be required to operate successfully in a virtual environment? So collaboration tools. I've already mentioned Zoom as a really, really effective tool. I'm not sure if anyone's seen the headlines, but Zoom is signing up accounts as fast as it can, and its stock price has actually climbed while the rest of the market was declined. And that's because it meets a need in the current environment. You also might need to add some structure to share drives that hasn't been there before, so that people know where to find things and how to store final support and documentation. So as you're thinking through these questions, we've listed a few buckets to consider down at the bottom of this slide. The first is system dependencies, and we've already touched on this a couple of times, but the idea here is to ensure that you've considered three things. One, making sure your team has the hardware and system access that they'll need remotely to be successful. Two, that everyone has access and is trained up on collaboration tools that the team will use. And three, that you consider other potential ways to use technology to virtualize processes that used to be physical processes. Again, we talked about putting snips of work papers and emails, adding photos if you don't have scanners, stuff like that. Next, we've listed some process modifications that should be considered. Pre-planning is a big theme here. Spend time as a team thinking through required tasks that will be challenging in a remote environment. Things like payables and reconciliations. Or even outside the close process, issues like paying vendors if you have historically cut physical checks. Discuss, agree upon, and document workarounds so that everyone is clear on what changes are going to occur in the virtual environment. Some of the proposed workarounds may only be theoretical and haven't been performed. If possible, don't wait until time is critical to test out these processes. Test the new workarounds out in advance and make sure you can execute when the time comes. Next, consider what the need to extend deadlines based on potential challenges presented by these workarounds. Be sure to consider that new processes will present unknown challenges. Things that possibly look easy on paper may be more difficult to execute in real life. Change management will be a challenge. Lots could be changing, and making sure that everyone's marching in the same direction will require effort. So if you have a closed checklist or closed calendar, be sure to make changes to it for redesigned processes, highlight the changes, distribute it to the team, and make sure expectations are clearly documented. Finally, be sure to clearly communicate changes and follow up with recurring virtual meetings both before and during the closed processes to make sure that everyone is properly supported and questions or challenges are surfaced at the appropriate level. Finally, give consideration to resource support. Identify key person dependencies and consider needs for cross-training or documentation of key tasks in the event that team members or their families are impacted by the virus. Be sure to stay close to new team members or team members that picked up new tasks recently. These are people that you would invest in and develop if you were working in an office environment. And don't forget that. Consider how you can support their development virtually and spend a little bit of extra time with them. And finally, for your entire team, emphasize the need for more collaboration and teamwork as you're figuring out how to be successful in a remote environment. Finally, on this final slide, I wanted to hit on some soft skill tips for working remote. Many are common sense, but they're worth mentioning. So for instance, continuous reinforcement of important messaging. Don't forget, everyone's heard schools are closed, families are all at home together in a small environment that you're not used to. There's lots of distractions and lots going on. So don't assume because the message is mentioned once that it's fully absorbed. Reinforce deadlines, reinforce important messages, potentially break up complicated material as much as possible, bullet points in emails, different ways to communicate via text, via Skype, via email, phone call. Continue to pound the message and make sure it's received. Second, excessive extensions are required, and discuss that with your team. As we mentioned before, decisions tend to be made faster when in person and slower in remote environments. If you think about it, when you're in person, you can get quick confirmation, you can close off issues. In this remote environment, we pick up the phone, we get voicemail, we send an email, we're waiting on response. And that happens throughout the entire communication chain. So things are just going to take longer. So discuss any potential needs for extending project deadlines or the criticality of individual items and how they're going to affect the rest of your projects. Third, transparency becomes even more important. So without regular face-to-face interaction, messages can get lost. If you think about communication in person, you've got the verbal message, but there's so many nonverbals that you're picking up on. You're picking up on facial expressions and body language, things that are hard to be able to replicate in a remote environment. To the extent you can utilize video conferencing, that helps. But to the extent that communication is happening over the phone or email or text, be aware that maybe some of that normal nonverbal communication is getting lost in the message, and make sure that you are communicating your theme appropriately. Next, try and reach out to individuals regularly if you're part of a regular team. When you're dealing with large conference calls, large team meetings in a virtual environment, understand the distractions, as we mentioned, that people are going to be affected with by working at home. And then understand also that you're going to have quieter team members who don't necessarily raise issues or voice concerns. Be aware of this dynamic, reach out to individuals, particularly critical individuals who are maybe quiet on a call or didn't respond in the way that you had anticipated. Make sure the message is received and that everybody's marching in the same direction. And then finally, build in some unstructured time to each call. If you think about in-person meetings, there's a lot of time that's spent, or a few minutes of time that's spent at the beginning of each meeting and at the end, where social bonds are made, right? It's not necessarily related to the meeting itself, but it's connecting, seeing how team members are doing, sharing stories. It's an important opportunity to be able to maintain the cohesiveness of your team, to allow a little bit of time at the beginning and ending of meetings to continue to foster those personal relationships. Now, obviously, you're all doing it within the context of still being able to accomplish the tasks that you have for that meeting. So as I wrap up here, just wanted to re-emphasize, we've gone over a lot, but the major lessons here and the major themes I'm trying to get across are, number one, detailed planning. think through the details of where the risks are in your close process, where the risks are in your team structure, and address them quickly. Secondly, think creatively. Look for opportunities to use a lot of technology that's available to us today that potentially we overlook to help solve some of your problems. Third, make sure you over communicate. Stay close to your team members, communicate important messages, and continue to hold up the team morale. And then last, I just encourage you, don't miss the opportunity to debrief at the end of March close. You're going to learn a lot. You're going to be presented with a lot of challenges, and it's good to go through those challenges, talk about what worked well, what didn't work well, because you may have to repeat this process in April. And in best case, even if you don't, we're back to a normal working environment at the beginning of May. You can take these lessons learned and improve your processes and reduce your risk in your financial reporting prospectively. So with that, let's take a look at our first polling question. Can we advance the slide here? There we go. So which has posed the greatest challenge for the accounting and finance function working through your challenges presented by COVID-19? A, the remote working environment. B, managing special requests, which Keith hit on earlier. C, new accounting issues. Or D, IT challenges. So while you're working through those answers, let's transition from operational challenges that we've been talking about today in today's work environment to accounting and financial reporting considerations that should be on your radar during this time. And with that, I'll hand it over to Drew and Sasha.
Thanks, Todd. As we tally the responses here, I wanted to mention that yesterday the SEC extended the time period covered by its COVID-19 related filing relief. The SEC had previously issued relief for filings due on or before April 30th. The new order extends to filings due between March 1st and July 1st. So effectively, this means that relief can be applied to forms 10K and 10Q that have periods ending March 31st, which likely will include many first quarter 10Qs. So it looks like the results of the poll are in or coming in. The remote working environment seems to be the leader in the clubhouse, followed by managing special requests as the two most challenging areas as people are working through kind of this new environment. So you should be able to see the results now. So if we want to move on to the next slide, let's pivot to a discussion of accounting matters. As we've been working with our clients over the recent days and weeks, one thing that's clear is that accounting and finance teams have their hands full as they help companies respond to the COVID-19 outbreak. Keith and Todd touched on a number of ways that these teams are supporting businesses and operational decisions, not to mention continuing to report monthly results in a remote setting. Incremental to those tasks are not insignificant list of new accounting and financial reporting considerations to work through as a result of the changing circumstances for companies, their suppliers, customers, and stakeholders. So let's start with revenue on the next slide. As everyone tightens the reins on cash right now, collectability is likely to be a concern for many companies who haven't had to face that issue on a macro scale before. The topic of collectability is actually front and center in step 1 of the new revenue recognition standard, ASC 606. If a company concludes that a customer does not have the intent and ability to pay as amounts become due, a contract may not exist for new transactions. Evaluating a customer's intent and ability in the current environment is probably going to be difficult. So here are a few things to consider. 1, when evaluating collectability, you should take into account any potential price concessions that you expect to provide, which again is probably an uncommon scenario for most companies and something that wouldn't likely be thought of in a collectability analysis. That may impact a customer's ability to pay. Second, and at the risk of stating the obvious, if you have a customer that is failing to pay existing receivables, it would be difficult to conclude that collection for new sales is probable. And as a result, you would likely conclude no contract exists. So if that is how to think through collectibility as it relates to new transactions, the next step is to think about how to account for collectibility issues for your currently outstanding accounts receivable. Regardless of whether you've adopted ASC 326 or CECL, it's very likely you should be developing an additional credit loss reserve related to the impact of COVID-19. Using the CECL model, considering the impact of the outbreak would be part of a reasonable and supportable forecast. And under legacy guidance, the outbreak certainly represents a potential loss event that should require you to reevaluate your current AR balance. But it's probably obvious that you should be reevaluating your reserve. I think the better question is, how do you do that in this environment? Evaluating concentrations of risk by geography and industry is a good start. We were recently working with a chemicals company that produces pesticides, among other products, that are distributed globally. And conversations eventually focused around concerns regarding collectibility within developing nations, which are lagging in their impact of COVID-19, but in all likelihood will jump up very quickly here. That point came about as a result of an interdepartmental video conference. So just as accounting and finance teams are likely supporting other decision makers in your organization, don't go this alone. Reach out to your FP&A team to understand what factors they are monitoring. And depending on the nature of your circumstance, it may be helpful to look back at previous periods of volatility, even going back to the financial crisis, to see what the impact on receivables was at that time. Continuing with our discussion of AR, it is possible or even likely that your company is working with customers to extend payment terms. In this instance, where those terms extend beyond a year, accounting teams may need to evaluate whether this adds a significant financing component to your contract. This would require you to adjust the transaction price for the time value of money and record the difference to interest income. Changes like these to customer contracts may be made for many reasons. Often in response to the outbreak, changes are going to extend beyond payment terms. For example, to reduce the scope of the contract to only include necessary products and services to your customers. Capturing these changes is important. Ensure there is a clear line of communication between sales teams that are structuring those changes and the accounting department to inventory these changes so the appropriate contract modification guidance can be applied. Okay, moving on to the next slide. Let's wrap up our discussion of revenue by talking about variable consideration. As a reminder, when a contract includes variable consideration, things like rebates, bonuses, penalties, a company is typically required to estimate the amount of consideration it will receive and update that estimate each reporting period. Keep in mind that the threshold that applies in ASC 606 for recognition, or when the constraint can be lifted, related to variable consideration, is when, quote, it is probable that a significant reversal of revenue will not occur. When thinking through whether or not you have any contracts that are impacted, there may be certain contract conditions that have previously been essentially no-brainers. Things like performance bonuses that are consistently received, or minimum spend targets that are always hit, which unlocked reduced pricing. These types of items most likely require a fresh set of eyes given the current economic conditions when determining the transaction price. And earlier, we touched on contract modifications. We've been talking to clients who are trying to restructure contracts to include terms that they have never used before, things like volume-based rebates to drive demand. These require estimation. It's important that your sales teams are communicating any such changes to the accounting group. Another common contract provision that may require a fresh look is service level agreements, which require refunds if certain reliability or other target metrics are not met by a service provider. Historically, such outages or breaches of the SLA may have been too infrequent to estimate any reduction in revenue. However, companies may be experiencing difficulty meeting these SLA reliability metrics consistently given disruptions in workforce or supplies, which may be cause to revisit the estimated transaction price. I want to end our discussion of revenue with a couple quick points on sales returns. If a company is updating its policies to accept sales returns where it hasn't before, accounting teams should consider to what extent the transaction price is constrained. Again, this may be difficult without any historical evidence, but reaching out to the sales teams and FP&A teams can be helpful. And to build on that point, companies with visibility into sales channels such as resellers and distributors should consider whether the sales channel is full or getting full. This data can be useful to conclude on a more accurate revenue estimate related to potential returns. That brings us to the end of revenue. Now, Sasha is going to take us through some things to keep top of mind when considering potential impairment.
Thanks, Drew. If we go to the next slide, many companies are already starting to consider whether the effects of COVID-19 and resulting macroeconomic conditions represent triggering events which will require companies to perform impairment tests during Q1. Just as a reminder, setting aside the COVID-19 issue, when it comes to goodwill impairment, companies are required to test the goodwill annually. Companies also need to test goodwill for impairment between annual tests if an event occurs or circumstances change that would more likely than not result in the fair value of the reporting unit being lower than its carrying amount. For long-lived assets, there is no annual impairment test requirement. Instead, long-lived assets are tested for impairment when triggering events occur that suggest that asset group may not be recoverable. If those triggers exist, the recoverability test is performed by comparing undiscounted cash flows to the carrying value. If the estimated undiscounted cash flows are less than the carrying amount of the long-lived assets, the companies have to move to step 3 of the impairment model, where the fair value of assets is compared to the carrying value and the difference is recorded as impairment charge. For both impairment models, impacts of COVID-19, such as stock volatility, supply chain disruption, decline in revenue and demand, especially in service-based industries, will most likely be considered triggering events. Even if companies are not directly impacted by the virus, it will be challenging to assert that there are no triggers for impairment given general disruption in the economy. When it comes to impairment testing, current economic events will make the assessment of fair value especially challenging, as companies will have to revise their projections, forecasts, discount rates, and other assumptions when going through the impairment test for both goodwill and long-lived assets. If you're approaching your period-end reporting, it would be important to consider potential impairment as soon as possible, as impairment tests are expected to take much more time and cost to complete in this environment. Questions often arise in situations when triggers suggest that not only goodwill but other assets are impaired. What order do I do my impairment testing? There is specific guidance that addresses this question. Testing should be performed in the following order. First, test the assets such as inventory, accounts receivable. Then you move to testing indefinite-lived intangible assets other than goodwill. After that, the long-lived assets impairment test is performed. And lastly, after those impairment tests are completed, goodwill of the reporting unit, which includes all those tested assets, should be assessed for impairment. You'll have to adjust carrying value of all tested assets prior to performing the next test. If we move to the next slide, we'll talk a little bit about other areas that are impacted by COVID-19 in terms of impairment. Generally, inventory is recorded at lower of cost to market or net realizable value. Disruption in supply chain and low sales volume due to outbreak may result in adjustments to carry value of inventory. Declines in net realizable value should be recorded as an expense when incurred. Other notable issue to consider regarding inventory given current situation is that normally overhead costs are capitalized in inventory. However, when production is abnormally low, then those costs will have to be recognized in cost of goods sold directly. Generally, we would expect to see a lot more inventory reserves, write-downs of inventories which cannot be sold, especially in the retail space. Other assets on the balance sheet that should be evaluated closely as a result of current situation are equity method investments. Similar to long-lived assets, equity method investments are tested for impairment whenever events or change in the circumstances indicate that the carrying amount of the investment may not be recoverable. If the fair value of the investment is less than its carrying amount, and the investment will not recover in the near term, then other than temporary impairment may exist. Evaluating whether impairment is other than temporary in current environment will be quite challenging. And now with that, we'll move to our second polling question. The question is, has your company begun any impairment evaluation during first quarter? A is yes, B is no, C considering it, and D not applicable. As we're waiting for responses, I wanted to mention that many companies before this crisis hit used to perform what we call step 0 goodwill impairment tests, where companies performed qualitative analysis to determine if goodwill impairment exists. Under current economic environment, it is less likely or practically impossible for companies to continue to use such approach. Drew, can you share what other issues companies are facing when completing their impairment tests now in the COVID-19 environment?
Sure. I recognize that creating and supporting forecasts in this environment is going to be incredibly difficult. And we actually got a question earlier on, do we expect to see additional impairments as part of this first quarter analysis, or is this going to have just a short-term limited impact to the value of assets? I wanted to just share a little anecdote that will kind of talk about that point. So there's a discussion yesterday with the CEO of Slack, which is an online communication tool, and he touched on this point. In the near term, they've gained additional customers at a rate that was consistent with goals that they set for multiple years out. However, he acknowledged that it's possible that thousands of those customers won't have cash for non-essential spending within a few months. So simply forecasting even a modest growth curve wasn't necessarily appropriate. And he also mentioned that as we advance the time horizon for forecast planning, the possibility of different outcomes becomes broader and broader, almost exponentially, unlike in historical periods where it is broader, but not quite to the degree it is now. So this uncertainty is why that we're recommending, and you'll hear throughout this webcast, to keep in contact with others in your organization to ensure you're getting all perspectives. So, for example, how does any government subsidies, grants, or help impact the viability of your company in the short term? Obviously, as discussed earlier, are you among an industry that has suppliers or customers that are more significantly impacted than potentially your core operations themselves? So this is all maybe a long way of saying that I think it's inevitable that there are going to be additional impairments within this period. I think most people are trying to gather as much information as they can from all these sources, which is, again, why you want to talk to your treasurer and your sales folks to understand what they're hearing from customers and what the company's plans are to ensure funding. Because it's certainly possible within the near term there is a higher level of uncertainty, but if the company believes they have the right resources to weather that storm, then the long-term forecasts that are supporting these impairment analyses are more likely than not to be able to support there may not be an impairment. And it's funny, consider how much of a potential fair value of future cash flows comes from just the terminal value period, right? Even with a nominal growth rate of 2.5 or 3%, so much of that value comes from that incremental terminal value period that it comes down to how can we weather this short-term break. So I just wanted to provide a little color there. I think the polling's wrapped up, and basically it looks like the majority are viewing not applicable for impairment evaluations. Beyond that, it seems like a quarter of the participants are at least considering it, and a fifth are saying, yes, we've begun it. So moving on, let's stay with impairment for a little bit on the next slide and talk about leasing. Companies that have adopted the new leasing standard likely will have several new right-of-use assets on their balance sheet related to operating leases. In order to determine if these assets are impaired, companies should follow the guidance in AS 360 on impairment for long-lived assets that Sasha mentioned. Of course, the next step is, how do I now amortize an impaired right-of-use asset where my previously put together impairment schedule is probably not relevant anymore? The good news is it gets a little simpler. In this case, you would amortize that asset on a straight line basis over the remaining lease term and continue to present the right-of-use asset reduction and interest accretion related to the lease liability as a single line item on the P&L. But what about lessors? So for sales type and direct financing leases, the guidance on credit losses applies, either ASC 326, CECL if adopted, or ASC 310 if legacy guidance still applies. One important reminder here, when determining the loss allowance for a lease, the lessor should take into consideration the collateral relating to the net investment in the lease. So said differently, include the cash flows you can expect to receive from the underlying asset at the end of the lease term, which would probably reduce your loss allowance. For operating leases, lessors need to assess collectability under the terms of 842. So let's focus on the scenario where the assessment of collectability changes after the lease commencement date, which is likely happening for many lessors right now. In this instance, when lease payments are deemed uncollectible, any difference between the lease income that would have been recognized originally and the lease payments that have been collected already should be recognized in the current period as an adjustment to lease income. Okay, that covers lease impairments. Let's stick with leases and talk about rent concessions agreed upon by lessors. In many places, as Keith mentioned at the beginning, the outbreak of the novel coronavirus has forced the temporary closure of shopping centers, office buildings, restaurants, and many other structures. As a result, it's possible landlords are not obligating tenants to pay rent for these periods. And another possibility is that landlords may be offering concessions to tenants in the form of decreased rent in future periods. So how do lessors account for these concessions? First, the lessor should determine if there is a force majeure clause in the contract between the parties. One key reminder here, when evaluating the rights and obligations in a contract, parties should consider that rights and obligations may come from the laws of the jurisdiction governing the contract, in addition to what is discreetly spelled out in the contract itself. So what if there is a force majeure clause? In that case, the concession is accounted for as a variable lease payment. Well, what do we mean when we say variable lease payment? Basically, since there's no lease modification because the contract terms accounted for a condition like this, the parties continue to account for the lease under the original contract. The rent concession is essentially a negative payment, resulting in negative variable rent in the applicable periods. If there is no force majeure clause, the lessor isn't under any obligation to grant the concession. In that case, the concession should be considered a lease modification. Generally, this means you would account for the concession on a prospective basis. So said differently, the amount of the concession will be recognized as a reduction to lease income for the lessor if it's an operating lease over the remainder of the term. Okay, moving on from leases and on to the next slide, we want to touch super briefly on a few areas in income tax that may be relevant as companies work through the impact of the outbreak. As companies are evaluating their cash on hand, it's possible and even likely that there are plans in place to repatriate earnings from foreign locations. If these funds had previously been designated as indefinitely reinvested and companies want to change this assertion, the associated unrealized foreign currency gains and losses would be realized in a net income, which could have a significant impact to income statements. Additionally, you need to consider deferred taxes related to that previously unrealized CTA. Changing the indefinite reinvested assertion has historically been an infrequent occurrence, outside of the recent change in tax laws, which allowed for this one-off event. We've had conversations with auditors and other stakeholders where it was determined that it would take essentially an act of God to change this assertion. Well, here we are. So point is, as this is something that you may not often consider, ensure you are in contact with your corporate treasurer or treasury department to understand any plans to move funds across borders. Next, accounting teams will want to consider the impact of the outbreak on valuation allowances that have been established on deferred tax assets. Typically, when considering what negative evidence exists that would reduce the likelihood of having income in future years to be offset by NOLs, you may focus on historical losses and performance. However, current events that may negatively impact future results are also considered negative evidence. Accounting teams should stay in lockstep with FP&A and other organizational leaders to ensure future forecasts and other forward-looking information they're using to evaluate the appropriateness of valuation allowances is consistent with what the company is considering internally and communicating externally to stakeholders. Very briefly, our last point on tax relates to estimating annual effective tax rates. Without question, it's going to be much more difficult in this environment to establish a forecasted full-year tax rate with so much uncertainty. However, it's helpful to keep in mind that any gains or losses from unusual or infrequently incurring items should be excluded from the estimated annual effective tax rate calculation. Instead, they're recorded on a discrete basis in the period that the infrequent event occurs. Okay, next slide. Let's really quickly touch on some other considerations, a few one-off items that the accounting team should be considering. First, it's possible that now or in the coming quarters, compensation committees will meet and determine it's appropriate to adjust things like stock option terms to level set with the company's revised outlook. Just remember that any modification to earning targets in an instrument like a stock option may trigger the instrument to vest or even alter the probability of vesting. And that may be considered a modification of the award, potentially resulting in a P&L impact. Similar considerations should be considered regarding any contingent consideration where there are operational targets such as EBITDA that would require an impact to the fair value assessment as the company deems it more or less likely those targets will be met. With that, let's bring up our third polling question. What accounting and financial reporting area do you expect to be the most challenging during the Q1 close as a result of the COVID-19 crisis? Revenue recognition, asset impairment, inventory valuation, or other? While we wait for the results to come in, I wanted to touch on discount rates for a second. We have discussed several impairment and other fair value analyses that rely on discount rates to be used in an undiscounted cash flow technique. So it's fair to wonder how the significant decline in interest rates recently should be considered in calculating the discount rate. While the risk-free rate, often approximated by treasury yields, has decreased significantly, keep in mind that there are many inputs in determining the proper rate, and it should be adjusted for risks in the cash flow forecast. So, for example, although the risk-free component of the rate may have decreased, it's very likely that there's greater risk in your cash flow forecast now than prior to the different treasury rates, which may offset any potential decline in your discount rate. So it looks like the results are coming in, and there's kind of an even split between revenue recognition and asset impairment in terms of the most significant impacted area, which makes sense and kind of comes as no surprise. Sasha, do you want to lead us in discussing going concern and some other disclosure items?
Sure, Joe, thank you. So even if some companies do not anticipate going concern issues, we expect that this would be a heightened area of focus for auditors in a quite foreseeable future. This is because going concern analysis focus on a relatively short period of time of 1 year after the financial statements are issued. So even if you believe that your business is not impacted long term, you would be expecting to have a robust analysis of why you believe that there is no going concern issues in the short run. Companies' going concern analysis will have to evaluate all economic impacts of the outbreak on operations, such as supply chain disruption, issues with AR collectability, plant closures, and others. This is also the time to carefully review all debt covenants to ensure if violation may occur. Some covenants have positions surrounding going concern opinions from auditors. It will be important to start negotiations with banks early on to ensure that some of the restrictive covenants wait timely. Now let's talk a little bit about disclosures and how to go about disclosing impacts of COVID-19 on the next slide. Private companies which are in the process of completing their 2019 audits, and for public companies entering Q1 reporting, they would have to assess COVID-19 related sub-events to determine whether they should be either recorded in the financial statements or disclosed. Just as a reminder, there are two types of sub-events. Type 1, events that existed at the balance sheet date and which should be reflected in the financial statements, and type 2 events that did not exist at the balance sheet date and should only be disclosed. As it relates to loss contingencies, after the balance sheet date but before the financial statements are issued or are available to be issued, information may become available indicating that an asset was impaired or liability was incurred after the balance sheet date, or that there is at least a reasonable possibility that an asset was impaired or liability was incurred after that date. If the underlying causal event did not occur before the balance sheet date, an accrual should not be made. However, disclosures may still be required. Such disclosures should include the nature of the contingency and an estimate of the possible loss or range of loss, or statement that such an estimate cannot be made. Moving on to the next slide, I'd like to mention recent guidance that just was issued by the Division of Corporate Finance yesterday, topic number 9, which provides more information related to the disclosures of COVID-19 impacts. SEC stated that the risks and effects of COVID-19, including how the company and management are responding to them, should be specific to the company's situation. This guidance provides examples of questions for companies to consider as they evaluate their disclosure obligations. Examples of the questions SEC wants companies to consider include considerations on how COVID-19 impacted companies' financial conditions and results of operations, whether companies anticipate any material impairments, increase in allowances for credit losses, restructuring charges, or changes in accounting judgments that have had or reasonably likely to have a material impact on the company's financial statements. Given an interest of time, I won't list other questions that they raised, but you can find a complete list of suggestions from the Division of Corporate Finance on the SEC website. And now, since we are approaching our time, I'd like to move on to our last polling question. Have you discussed the potential for going concern analysis with your auditors yet? A, yes, B, no, C, planning on it, and D, not applicable. And while we're waiting for the responses, we had a number of questions that came up during the session or before that, and I'd like to answer some of them. The first question that was raised, for the companies that haven't finalized year-end financials or non-calendar year, which ends on 3/31 or 2/29, how much consideration should they place on what they know versus what they knew as of the final balance sheet date? So I'd like to go back to the discussion we had in the earlier slide about determining whether you knew about the events that existed at the balance sheet date. So if you had triggers of impairment, such as decline in sales, increase in inventory, or other triggers, that event would have to be considered a type 1 event, and you would have to figure out the impairment charge and record it and recognize the impairment charge at the balance sheet date. Obviously, if that was event that had no relation to the information that you knew as of balance sheet date, you would have to only consider disclosing it. Also, it's important to make sure that when you look at the impairment analysis, you evaluate whether decline in sales or other triggers are truly because of the COVID-19, or are they really indicator of other conditions that there could be a reasonable possibility that those conditions existed before the balance sheet date. Drew, I believe that there's another question that you wanted to address regarding the debt covenant.
Yeah, well, we actually had a number of additional questions come in, but we are at our hour mark. So we will reach out and address those questions separately. But that does bring us to the end of our allotted time. So as a quick reminder, there are several resources available on our website for companies working through these and other matters related to the COVID-19 outbreak. Thanks everyone for joining today's webinar. We look forward to meeting with you again in future webinars. Enjoy the rest of your day.